Most adults are making financial decisions every single day. What to spend, what to save, whether to invest, how much debt is too much, without ever having a framework for how those decisions fit together. And that's not a character flaw. Nobody teaches this. You don't learn it in school. You mostly pick it up through trial and error, which is a very expensive way to figure out something this important. What professional financial planners use, and what most people never get exposure to, is a structured process. A sequence of steps that, when followed, turns financial chaos into a clear and actionable plan. This process has been formalized by the CFP Board, the organization that certifies financial planners in the United States. And it applies whether you're planning your own finances or working with an advisor. 6 steps in a specific order that cover everything from understanding where you are today to making sure your plan keeps working as your life changes. Today, we're walking through all 6. This is one of those videos that's worth taking notes on. Welcome to Global Finance Watch, where we break down the strategies, trends, and decisions that drive real financial outcomes. Subscribe if you haven't. We put out finance education and market analysis every week. Step 1. Establish the relationship and define the scope. When you're working with a financial planner, this step is about setting expectations, understanding what the planner will and won't do, how they're compensated, and what areas of your financial life the engagement covers. But when you're doing this yourself, step 1 is about defining your scope. What parts of your financial life are you actually going to address? This sounds obvious, but most people skip it. They think about money in fragments. They stress about debt on one day, wonder about retirement on another, and feel vague anxiety about insurance the week after. There's no connective tissue, no sense of the whole picture. Starting with scope means deciding up front. Are you doing a full financial plan that covers everything? Income, debt, savings, insurance, investing, estate planning, taxes? Or are you focused on a specific area right now, like getting out of debt or planning for a home purchase? Both are valid. The point is to be intentional about it so you know what you're committing to. For most people going through this process for the first time, a full financial plan is worth the effort. You'll likely discover that areas you thought were unrelated are actually deeply connected. Your debt payoff strategy affects how much you can invest. Your insurance gaps affect how much risk your financial plan can actually tolerate. Your tax strategy affects how much of your investment growth you actually keep. The financial planning process works best when you see those connections, and that only happens when you look at the whole picture at once. Step 2. Gather data and understand your current situation. This is the foundation everything else is built on. Before you can set goals or build a strategy, you need an honest and complete picture of where you stand right now. That means pulling together the numbers, all of them. On the asset side, checking and savings account balances, investment and retirement account balances, the value of any property you own, any business equity. On the liability side, every debt balance and its interest rate, mortgage, car loans, student loans, personal loans, credit card balances. Your monthly income, all sources. Your monthly expenses, all categories, not a rough estimate, but actual spending data. And your insurance coverage, health, life, disability, property. Beyond the numbers, this step also includes understanding your situation in a broader sense. Your tax filing status and bracket. Whether you have dependents, your job stability, whether you're expecting any major life changes in the next few years, a marriage, a child, a career shift, a move. The goal of this step is to build what planners call a financial inventory. Think of it as a photograph of your financial life, taken today, that's accurate enough to make real decisions from. Most people who do this carefully are surprised by what they find. Both problems they weren't fully facing and strengths they were underestimating. One practical note, gathering this data is easier than it used to be. Most banks, brokerages, and loan servicers give you online access to exact balances and account details. A single afternoon with your accounts open and a spreadsheet in front of you is usually enough to complete this step. Step 3. Analyze the data and identify strengths and gaps. Once you have your financial inventory, the next step is to actually look at it analytically. This is where you move from description to diagnosis. What does your cash flow look like? Are you spending more than you earn, breaking even, or consistently saving a meaningful percentage? What's your debt-to-income ratio, and how does that compare to healthy benchmarks? What's your net worth, and is it moving in the right direction? How much of your income is protected by life or disability insurance if something goes wrong? Are you on track to retire at your target age based on your current savings rate, or are you significantly behind? This step is often where people feel the most discomfort because it requires being honest about gaps. Maybe you're saving but not nearly enough given your timeline. Maybe your insurance is woefully inadequate. Maybe your debt is costing you more in interest than your investments are earning. These aren't comfortable things to see clearly, but they are exactly the things you need to see clearly in order to change them. Strengths matter here too. If you have no consumer debt, that's a significant advantage. If you've been contributing to a 401k for years, that's compounding in your favor. If you have a fully funded emergency fund, that's a layer of protection most people lack. Understanding what's working is as important as identifying what isn't, because it tells you where your plan can lean. Step 4. Develop the financial plan. This is where strategy meets reality. Based on everything you gathered and analyzed in steps 2 and 3, you now build an actual plan, specific goals with specific numbers attached to them, and specific strategies for reaching each one. A complete financial plan typically covers several areas. A debt strategy. If you have high-interest debt, how are you eliminating it, and in what order? A savings and cash flow strategy. What percentage of your income are you directing toward financial goals, and where is it going? An investment strategy. What accounts are you using? What are you investing in? And what's your target asset allocation based on your time horizon and risk tolerance? A protection strategy. Do you have adequate insurance to cover income loss, health emergencies, and the people who depend on you? A tax strategy. Are you taking advantage of tax-advantaged accounts? And are there legal ways to reduce your tax burden? And for those further along, an estate planning component. Do you have a will, a beneficiary designations review, and a plan for what happens to your assets? Each of these areas should have goals that are specific and measurable. Not, I want to save more, but I will save 15% of my gross income starting this month. Not, I want to pay off my debt, but I will have my credit card balances at zero within 18 months by directing $400 a month toward the balance with the highest interest rate. Vague intentions don't become financial plans. Specific targets with timelines do. Step 5. Implement the plan. A financial plan that doesn't get executed is just a document. Step 5 is where the plan becomes action, and this is where most people stall. Implementation means actually opening the accounts, setting up the automatic transfers, calling the insurance company, updating the beneficiaries, making the extra debt payment. It means doing the things that feel administrative and slightly tedious, but that are the difference between having a plan and living one. A few things that make implementation more likely to happen. First, automate wherever you can. Automatic contributions to investment accounts, automatic transfers to savings, automatic extra payments toward debt. These remove the human decision point that creates friction. When the money moves before you see it, you don't have to rely on willpower. Second, sequence your actions. You don't have to do everything at once. Start with the highest leverage items, usually eliminating high-interest debt and capturing any employer 401k match, and work through the plan systematically. Third, set a deadline for each action. Telling yourself you'll get around to increasing your 401k contribution is very different from committing to doing it by the end of this week. The implementation step is also where working with a financial advisor, if you use one, tends to add the most practical value. Not because the strategies are complicated, but because having someone hold you accountable to actually doing the things you agreed to do is a powerful driver of follow-through. Step 6. Monitor and update the plan. Financial planning isn't a one-time event, it's a process. And the final step, which actually loops back into the beginning, is building in the habit of reviewing and adjusting your plan as your life and circumstances change. Your income goes up, your family situation changes, markets shift, you hit a goal and need a new one. The tax code gets updated, you develop new priorities. Any of these things can change what the right financial strategy looks like for you. And a plan that made perfect sense 3 years ago might need meaningful revision today. The standard recommendation is a full plan review once a year, with smaller check-ins quarterly to make sure you're on track with your specific targets. Life events, a job change, a marriage, the birth of a child, an inheritance, a significant illness, should trigger an immediate review rather than waiting for the annual cycle. What you're watching for in these reviews is drift. Drift from your savings rate. Drift in your investment allocation as markets move and the mix shifts away from your targets. Drift in your coverage as your income and obligations grow, but your insurance doesn't. Catching drift early and correcting it is far less costly than letting it compound over years. The financial planning process is designed to be iterative precisely because life doesn't move in a straight line. The goal isn't a perfect, static plan. It's a living document that evolves with you and keeps your financial decisions connected to your actual goals. Let's run through all 6 steps one more time. Step 1. Establish the scope of your plan. Decide what areas of your financial life you're addressing and commit to seeing them as a connected whole. Step 2. Gather complete, accurate data on your current financial situation. Assets, liabilities, income, expenses, and insurance. Step 3. Analyze that data honestly to identify both your strengths and your gaps. Step 4. Develop a specific, written financial plan with measurable goals and clear strategies across debt, savings, investing, protection, and taxes. Step 5. Implement the plan. Automate what you can, sequence your actions, and set deadlines. Step 6. Monitor and update the plan regularly and revisit it whenever your life changes in a meaningful way. This is the process that financial professionals use with their clients. There's no reason you can't use it yourself. The difference between people who reach their financial goals and those who don't often comes down to exactly this. Not luck, not income, but whether they had a process and followed it. Start with step 1 today. You don't need a perfect plan yet. You just need to decide to have one. If this was useful, drop a comment below telling us which step you're on. Subscribe if you haven't, and check out our financial freedom and wealth building videos linked below if you want to go deeper on any of the strategies we covered here. We'll see you in the next one.